Yes, thanks, John, and good afternoon to everybody from Luxembourg. I always enjoy going to Cyprus, particularly in November, but I guess we all got used to work in this new format. Europe is experiencing, without doubt, the most challenging economic and financial crisis in our lifetime. Economic activity came to a halt in March after bottoming out in April. Data confirmed a strong recovery phase from May onwards as the lockdowns were lifted. However, the recovery lost momentum in August, and now, as we are experiencing the second wave, the pandemic weighs again heavily on our economies. Latest forecasts suggest that economic activity in the euro area will only reach its pre-crisis level again in late 2022. And the recovery is likely to be uneven across member states. How has Europe responded to this unprecedented crisis? Looking back, Europe provided a quick and well-coordinated policy response. Already by the beginning of April, the European economy was protected by three safety nets worth 540 billion euro. Each of these safety nets has a different purpose. First, the ESM's pandemic crisis support helps countries to cover direct and indirect healthcare costs. And although no money has been requested, the mere existence of our pandemic credit line has calmed financial markets. Second, the Commission's SURE program is the safety net for workers. And the third safety net, the new guarantee fund of the European Investment Bank, can be used to finance additional corporate investment. But the European rapid response did not end there. Monetary policy measures by the European Central Bank stabilized financial markets. And then in July, the 750 billion euro Next Generation EU Recovery Fund was adopted. The three safety nets and the Next Generation EU Fund were all designed in a way that countries most affected by the pandemic will receive more support. This unprecedented degree of solidarity is important to protect the EU single market and to avoid excessive divergences in our monetary union. Cyprus will receive a substantial amount of money from the European funds. This money presents Cyprus with a good opportunity to continue its structural reform efforts. In addition to these Europe-wide initiatives, all EU member states responded to the crisis with extensive national fiscal policy measures, also Cyprus. The Cypriot government put together a fiscal support package that alleviated the immediate impact of the crisis on the Cypriot economy. President Anastasiades mentioned at the beginning of this conference this afternoon that this policy package amounts to 1.3 billion euro. It protects the country's workers and firms. But every European country needs to recognize that these immediate measures must be accompanied by longer-term policies. And those policies will need to reflect the particular challenges in each country. Cyprus is a small open economy. It is exposed to a number of external risks. For example, during the first half of this year, tourist arrivals decreased by 85% compared with the previous year. Cyprus could make its economy more resilient by decreasing its dependence on tourism and diversifying further into other areas. The European Commission expects economic activity in Cyprus to fall by 6.2% this year, before recovering in 2021 and 22. And Cyprus has other challenges to overcome, particularly in its banking sector. The amount of non-performing loans in the balance sheet of Cypriot banks remains the second highest in the euro area. The Cypriot government has partially addressed this issue. Between 2014 and the first half of this year, the stock of NPLs declined from 24 billion euro to around 5 billion euro, a real significant progress, but still a high level. However, since non-performing loans will remain a challenge in the future, the legal framework needs to be strengthened, including the insolvency and foreclosure law. These are important challenges for Cyprus. The current crisis is very painful for all of Europe, but at the same time, it also provides the opportunity to accelerate structural changes in our economies and to accelerate progress towards deeper European integration, which I believe is crucial to overcome this crisis and to position Europe better in a changing world. Future growth in Europe is potentially affected by several problems. First, the pandemic destroys physical and human capital. Precautionary savings are up, and some investors will be reluctant to invest for some time given the uncertainties. This will depress demand. Second, the collapse in world trade and deglobalization mean less competition and thus lower productivity gains and lower growth. Third, banks continue to make too little profits in Europe, and NPLs will go up as GDP declines. This may limit banks' ability to provide sufficient credit for the recovery. And fourth, the higher public debt, although indispensable under the circumstances, can have a negative impact on growth in the long term. All these negative factors come on top of the well-known demographic problems, and all this is likely to lead to a potential growth rate after the crisis that may well be lower than before the crisis. Faced with these challenges, what can we do? The European agenda must focus on productivity and competitiveness, on making the European economy greener and more digital. That is exactly the objective of the New Generation EU Recovery Fund. A lot of money will be available. It must be used productively for investment and to support reforms in order to strengthen growth and to transform the European economies. In addition, we should also continue to deepen our monetary union. Important steps have been taken during the last decade. To complete this process and to make economic and monetary union more resilient and less vulnerable, additional steps are desirable. First, the completion of the ESM reform. In the future, with the revised ESM treaty, the ESM will provide a backstop to the Single Resolution Fund, increasing its financial firepower to deal with bank resolutions. That step is important to complete banking union, which also needs a common deposit guarantee and a better crisis management. Second, we need progress towards a capital markets union that would integrate the 27 national financial markets that we have today. Progress on the capital markets union would improve the allocation of capital in EMU, lead to more private sector risk sharing, increase the growth potential, and make the euro more attractive for international investors. Third, a fiscal stabilization instrument would help to shield economies of the euro area against future shocks. This would allow for more fiscal risk sharing. Such a permanent facility, which could be a revolving fund and not a budget, would give countries the opportunity to expand their fiscal space in a downturn. Several of the steps I mentioned are rather controversial among our member states. It will therefore take years to reach consensus and to implement them. But it would lead to a more integrated Europe, a more robust economic monetary union, and stronger growth. Such measures will help us to reach a vision of Europe that is more innovative, more resilient, and more sustainable, and where the international role of the euro would be stronger. And that is the Europe that we all want, I believe. Thank you very much.